Hey everybody, welcome to this free edition of our Trader Use Group, a weekly roundup for the trading week ending April 22nd, 2022. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is very appropriate. I see Fed hawks circling overhead. Clearly, the Fed's kind of set the direction for this market midweek, and we just kept going down from that point forward. The major indexes mostly ended lower this week, a pretty good bit, and you're going to see that pretty much all over. If we look at the performance, the Russell 1000 growth index gave up the most ground this week as the value counterpart did fairly good. The worst performer was communication sector, primarily because Netflix was in there and they just got really bashed. I mean, just totally bashed up. If we take a look at it, you can see here for the week, the Dow was down 1.86. Everybody else down for the week over 2 or 3%. You can see 3 of the 4 indexes year to date are in official correction territory, with NASDAQ almost in a bear market. Now remember, earlier this year it was in a bear market for like a day or so, and then it bounced back up. But we're heading back down there again. You look at the best performer for the week, believe it or not, it was real estate, up 1.25%. The worst was communication services, as I said, of which Netflix was a primary component there. Netflix fell over 35% for the week. So that just kind of dragged all of the communication services sector down. Facebook is part of that sector, so they just got killed. And you can see the worst performer for the year is also communication services. Best, of course, is energy, up 38, almost 39%. If you look at the PE ratio on the upper right, you can see the forward PE is a little over 19. And the dividend yield for the S&P came up just a little bit at 1.43%. 10-year Treasury finished higher this week, 2.91%. And the Treasury is about 51 basis points over the S&P dividend yield. All right, and you can see the earnings yield of the S&P is at 4.82%. Assuming the earnings per share right now about 205 a share, it's estimated to go up to around 220 this year, but we'll see. Lights out on that. But you can see the dividend earnings or the S&P earnings yield is at 4.82. That yield over the 10-year gives us a positive 1.91%. However, the real yield, when you factor in inflation, is still a negative 6.59. And the current VIX for the week was up almost 20% from prior week's close. The current VIX closed at 28.21%. So all in all, it was not a very good week for the U.S. markets. And of course, if we look at economic data for the week, or let's kind of zoom out to the global PMI was down from last month to this month. And we're seeing the services PMI also was down a little bit too. So everybody seems to be slowing down, although the PMIs are still over 50. Things are slowing down. Now, as I said before, Fed policymakers really came in with a very hawkish tone in public comments this past week. They were really, in my mind, the primary culprit for driving price action much lower as we ended the trading week. Bullard came out and basically suggested that he could see as much as a 75 basis point rate hike coming up on this May 4th meeting. But Fed Chair Jerome Power Ranger Boom Boom Powell, as we like to call him, had indicated that 50 basis point rate hike could be on the table for the May 4th policy press conference and policy statement. And he said that would be appropriate. And he also said moving a little bit more quickly in the rate hikes. All of these comments from Bullard to Power Ranger, Boom Boom Powell, to all these other Fed speakers, muckety mucks, basically was enough to really just increase the odds of a more aggressive hawkish stance for the Fed's near term. So what the market action really reflects is they're pricing in more rate hikes as we go through the end of the year. Okay. And that is basically how the markets are just revaluing and changing the valuation models of just about every company out there, right, to reflect a higher interest rate regime faster than normal. Of course, if we come over to Europe, we also had the pleasure of listening to the ECB president, Christine Queen Bee Lagarde. She reiterated that asset purchases, their program will conclude in the third quarter. And she's going to probably be forced to take on a little bit more of a hawkish stance as well. So we had both Boom Boom Powell and Queen Bee Lagarde, both of them coming out a little bit more hawkish than normal. And that kind of set the stage for not only Europe, but also the U.S. as well, right? And if we look at the Europe, and let's just kind of look at the rest of the planet, the major indexes, Euro Stocks, FTSE, CAC 40, DAX, all in the red for the week, but not nearly as severe as the Dow. Year to date, the only one in the green is the FTSE in the UK, believe it or not. It's barely up 1.86%. Everybody else is solid down. The Euro Stocks is in official correction territory. So is the DAX. The CAC 40 is at about 8% down year to date. So, and in fact, in the UK, their business activity grew at the slowest rate in 3 months in April, right? And they, just like the rest of Europe, just like the US, are facing record inflation pressures, right? And then on top of that, you got the war in Ukraine with Russia, which is going to affect the ag business, which then in turn affects just about everything else. And then you throw on top of it the supply chain woes that are coming out of the Asian markets. And it's just not very pretty out there. I mean, if we come over and look at the Asian markets, you can see the Nikkei was just about flat for the week. But year to date, it's down a little over 5.86%. China and Hang Seng had very ugly weeks. They're in official correction territory year to date as well. Going back to Japan, though, the yen is hovering around a 20-year low against the U.S. dollar, really ugly. And the Bank of Japan Governor Kuroda indicating that these negative effects of a weak currency need to be taken into account. Now, I don't know what the hell he means when they say that, but these Fed governors are these central bank governors, or they tend to just throw statements out there that you could they don't want to be seen as taking a hard stance one way or the other. Okay, although Japan recently upgraded their assessment for their index and for their economy, stating the Japanese economy is showing signs of picking up from their severe coronavirus situation, right? Their April flash PMI data showed also an expansion in their services sector. So, but they're just pumping so much money in the economy. In fact, the only two central banks putting money into the economy is the Bank of Japan and then the People's Bank of China. Those are the only two. And speaking of China, their market's continuing to slide because they've got, I think, Shanghai is in a hard lockdown, and there's like 42 major cities across China. They're in hard lockdowns, which control about 25% of their total GDP. So they're going to really have a hard time of growing GDP. In fact, the IMF cut their 2022 growth forecast to 4.4% from 4.8%. So they reduced their growth outlook by 40 basis points, although China's economy grew at a stronger than expected 4.8% pace in the first quarter. And that was up from 4% in Q4 of last year. But remember, that number for Q1 doesn't take into account these hard lockdowns. So we're going to see that come back down a pretty good little bit as we get into Q2. We get into Q2 numbers and so forth. So that's kind of what I see going on right now across the markets. Doesn't look that good, to be honest, right now. What I'm going to do is I'm going to shift you over, and I'm going to show you a clean chart of the E-mini S&P 500 futures. I've put on it a Fibonacci retracement, and then something that a lot of people don't use very much. It's called the Andrews Pitchfork, but it really helps define long-term trends and gives you boundaries around those trends. So let me just shift the screen over here, and I'm going to give you a clean chart and just kind of show you what it is saying. Let's get it over here like this. So give it a second or two to come up on the screen. And you're going to see these lines intersect in a couple of different areas. All right. And let me just explain how this works. So, all right. So if you look at this, this is a natural support point, and I'm using the pivot low of the COVID low and the pivot high of the 4804 that we made the second or third day of this trading year for the SPX, okay? And that defines this longer term. And again, this is a weekly chart, just so that we need to, take a step back and just kind of see where everything resides right now. And you can see from this COVID low right here, we put in $4 trillion, right? I can draw it on here. We put in $4 trillion. We doubled our balance sheet. All of this move right here, a ton of money into the markets. Now, so that's the pivot high. This is the pivot low down here. I added onto it the Andrews Pitchfork. And what I did was I took a pivot low over here and a pivot high here and then a pivot low here, leading up to the COVID crisis. This blue line right here tends to show you the mean central value of markets going up over a longer period of time. Now, this starts in 2019. And this would suggest, you can see how we got, and let me just clear the screen here real quick and just kind of go back and talk to it just a minute. You can see here with this 4 trillion, right, and hard money that we put into the markets always accelerates the market above trend, almost always. Because what it does is it drives interest rates very low, which was what the Fed thought was necessary when we hit these lows right here in this COVID panic. And it supported a lot of consumers. Consumers got a lot of money and the markets were shut down for a long period of time. Consumers didn't travel for essentially a year and a half, almost 2 summers, right? It happened right at the beginning of the 2020 spring break summertime, and it went all the way through 2020 into the summer of 2021. So this year, 2022, that's why you're seeing airlines, service, hospitality, hotels, cruise lines, all these playing catch up and doing a lot better because consumers have been locked up and they're starting to spend a lot of the money that they were given right here. All right, it's only natural. The other thing is, with all that money floating in the balance sheet, you're seeing that the money has no place to go but into the equity markets, because you're not going to make any money in the fixed income market at 0 to 25 basis points for this whole time frame, right? So now let's fast forward to where we are right now. You can see the Feds have already said they're going to cut the balance sheet. They're going to start taking money out of the balance sheet. They're going to start raising the interest rates, right? So they got to get the interest rates going. All this does has the propensity to start cutting that balance sheet and raising rates, i.e., we're taking money out of the markets. So it's only natural when we take money out of the markets, you're going to have consequences that are almost the opposite of what they were when you put money into the markets. And this doesn't happen overnight, but it will happen over 3 or 4 or 5 years. You will see the decade performance of the 20s going through 2030 a lot less than the decade of the 20s or 2010 to 2020 or 2000 to 2010. Even though those decades incorporated the dot-com bubble and the 08-09 crash, the big bounces out of those bear markets is what really gave the returns in the 2000 decade and the 2010 decade. We're now coming to the 2020 decade, and I think it's going to be a lot less. This trend line right here, to me, seems like a more normalized trend line. Now, if you look at it, as we got outside of this normal trend line, looking at the Andrews Pitchfork, we're now coming right back down to the upper boundary of it, which also centers us around the Fed, or the Fibonacci retracement cycle of 0.236%. A typical pullback in a very strong bullish market is 2.36%. But when you throw in a lot of inflation, you throw in an aggressive hawkish Fed, the range I like to say is 0.236 to 0.382. It can take us all the way down to 0.5. So to me, anywhere in this range right here makes the most sense as far as where the markets could go over the next couple of years. Okay. Now, just to give you some perspective near term, I do believe we're going to probably sell off a little bit more for a week or two. We may have a bounce. And the only thing that could change this paradigm near term, not longer term, but near term, is if the Feds on May 4th come out and hike the rates. Remember, I said Bullard suggested a 75 basis point rate hike, but Boom Boom Powell said 50 basis points. So let's just assume they do a 50 basis point rate hike. Okay. They're still really far behind compared to what the Fed fund futures is indicating and what the real yield is indicating. And members, this Sunday, we're going to spend some time and I'll show you again and remind you the calculations, and you can get it right out of Thinkorswim, how to calculate the real yield and where things can get ugly from a negative interest rate to a positive interest rate. But just from a price action standpoint, this range here, up around 4,400 down to around 30, let's call it 3,500, right? So you're looking at almost 1,000-point range here in the S&P. And if you look at this weekly chart here, it's not quite a head and shoulders, right? It's close, but not quite. And should it break below this, take out these year-to-date lows right here, the lows down here, it's going to run down somewhere down in this area here, somewhere around the median of that upsloping trend line that's been in place really since 2020. Okay. And that is kind of where I think we're going to be heading over time through the end of this year, through Q1 of next year. So this is a longer term chart, but it just kind of shows you what you need to prep for. Okay. So I found this very interesting and I wanted to show you guys just a longer term. Near term, we can have some bounces. In fact, the cycles that I'm seeing on my chart indicate we're going to start to move higher after the May 4th Fed meeting, because let's say Boom Boom Powell comes out and they in fact do a 50 basis point rate hike, but he indicates that that's enough for now. We may look at a 25 basis point. He's going to get the question of should we do another 50 or 75 basis point rate hike in the next session or the coming market sessions. And his comments, I think, are going to be interpreted as dovish. And because the market is pricing in a very hawkish Fed rate hike based on what the Fed voting members have been saying over the past week, Boom Boom Powell can come out and raise the rates, and yet the markets go up because he's not as hawkish. So just remember, it's all about expectations in the market, and that's what we're going to be tracking here. But that's kind of what I'm looking for right now. A little bit of a cycle low coming up through the end of April into May 4th. And then I'm looking for a run up through the end of May, going into June, and then another pullover July, August timeframe. That's kind of at a let's say on a weekly chart basis. But I wanted to share this with you. Members, we'll go into more detail. So far this year, we're solidly in the green. We're running about 25% returns. We're running actually about 30 to 35% annualized returns on our trades right now. And I just see a lot of opportunity coming up. Keep in mind, when we were running our user group back in 08 and 09, I actually founded our user group in September 2008. We got a lot of members that are still with us. We had some of our best years in 08 and 09, towards the end of 08 and into 09. And the low for the 08-09 great financial crisis was in March. I think March 6th or March 9th. March 6th, I think, of 2009. And we were really making bank at that time. So sometimes bear markets are really good. The way we work them, they're always good. We want to stay on the right side of the trend, be it up or down, using options, and our way of trading options really has been very helpful for us. All right. So that's a little bit about what I'm seeing in these two charts here. Now, what I'm going to do now is let me just take this off the screen. And let's go into another marked up view of the S&P E-mini futures. And now what I've got superimposed on here, and let's go back to a daily chart so that we can pay attention to the 50 and the 200 EMA. You can see this regression channel that's running down here. You can see the 50 EMA now has a downward cant to it, or a vector. The 200 EMA is slightly pointed down. We've blown right through the 50 and the 200 EMA. Folks, this is, although it's not a bear market chart where you are a bear market looking chart where the 50 is always below the 200. Here, if the 50 goes below the 200, this will be the final index in the U.S. markets where the 50 is below the 200. All the other indexes, from the Dow to NASDAQ 100 futures for the Russell, they're all, the 50 is well below the 200 EMA. The Dow is probably the tightest looking chart. I'll show you in a minute. But you can see here, so the overhead resistance is going to be back up in this area here, right between the 50 and the 200 EMA. Okay. Now, if we go and we take a look at the Dow, you're going to see here with the Dow, the 50 EMA is below the 200 EMA. Price action has come back below both of them, right? Heading solid down. So again, not a very good looking chart. And then if we look at NASDAQ, that's probably even uglier. You can see here, we're coming back down here, probably going to test our 2022 low where we were down. Now this is NASDAQ 100 futures, of which there's like 4 or 5 stocks that make up about 40% of the NASDAQ 100. It's 100 of the largest, essentially, tech companies in NASDAQ. You can see here, looking at challenging this low here of 22.31% to the downside. So not looking good for technology, especially if the Feds are going to get hot and heavy on hiking rates. Technology stocks don't fare that well here, right? And then, of course, if we look at the Russell, again, 50 well below the 200, coming back down to challenge the 2022 lows. They were made back over here on February 24th, and that was in a bear market officially here too. So all of our charts are bear market charts, which means the 50's below the 200, price actions below the 50 and the 200, obviously. The S&P is the only one where it's not a bear, a defined bear chart. The 50 is over the 200. Let's see if that holds. Typically, you do not have one of the indexes completely outperforming the other as it relates to the 50 and the 200 EMA for a period of time. What you will have is they all tend to go together. Now, granted, you'll have one lead the other, like we've had NASDAQ and technology essentially lead after the great financial reset in 08 and 09. You know, there's just so much money pumped in, growth stocks that don't pay dividends but are just growing like crazy. You'll see a lot of money chasing that. Right now, over the 2020 to 2030 decade, you're going to see a completely new regime, everybody. You're going to see a much slower growth rate. You're going to see money taking on different sectors than they've traditionally done. In fact, the old portfolio, the 60% equity, 40% bonds, is underwater almost 9% year to date. That ratio. So you're seeing everybody changing their allocations as we're moving forward. All right, they've been doing it really since Q4 of last year, but it's just been it's sped up as we've kind of moved through Q1, right? And our group, we're staying ahead of the game, but you can see what's going on. If we look at just the FANG index, this is an index of FANG. I've got to now adjust this. We've actually moved even lower, and I got to adjust and account for this new lower low in the FANG index, right? I mean, if I come in here and I look at it now, I've moved it down about 3 or 4%. So we're down almost 30%. So we're in clear bear market territory. My target for the FANG index is still a little bit lower, right? Still for it to go a little bit lower. So, and then if we look at the cyclicals, which tend to be holding up better, you can look at this chart right here. These right here, these are the primary cyclicals as it relates to the SPY. We had new 2022 highs on April the 18th. Now, what I've got in the cyclicals here is energy, financials, materials, and industrials. Hard assets, commodities, they tend to be more cyclical in nature. They tend to do well in a rising inflationary environment and interest rate environment. So again, for our members, we find those sectors that do well, we want to play them, and those that do horrible, like technology, or in this case, communication services and others, you want to be out of, especially software. They're going to get killed. The other one is in the hospitality sector. We're seeing some strong growth in there as well. If we come down and look at technology, well, I'm not technology, I'm sorry, volatility, you can see the big move over the 50 EMA. We're still in this pink zone, but if we move over 30, typically when you have a really hard down day on Friday, we see momentum continue forward on Monday. Sometimes we have a blow off bottom, flush more people out, and then Wednesday, Thursday, Friday, it ends up going up the remaining part of the week. But with the Feds just hell bent on raising rates more aggressively than the markets had anticipated, the markets are reacting to that. Remember, the markets, they sell first and ask questions later. So they're going to do the sell off as if they've already hiked the rates. And then boom, boom, Powell comes out and he hikes the rates. But if, let's say, he doesn't do it as strong as what the markets have already priced in, we'll get the rally. Hence, that's what I'm looking at for May. That's kind of where it sits right now with volatility. And of course, if we look at treasuries, we've made a killing in treasuries. We played treasuries to the downside. We jumped in pretty heavy earlier this year. You can see right in this area here is when I was talking about selling any rally in bonds, and it's just been a watershed. We've got members that are just making a killing in this. I get the emails on them, and they're just making a killing. So I do not want to sell short down here. You can see with the MACD, there is no divergences. That means we're still in a sell to rally mode. But I would not want to, I want to wait for a rally before I look at selling a rally and then a rollback over, and that would be a trigger to go short. Okay. That's kind of what I'm looking at in the bond market. And of course, if we look at the 10-year interest rates right here, you can see we've kind of stabilized, but we're up very high right here, right? Almost just slightly under 3%. And you can see the MACD here is really not giving us any divergences. So any sell-off in rates is going to be met by higher rates over the longer term. So just we've been trading these and been doing very well. If we look at the U.S. dollar, very strong on Friday. Probably got to adjust my thing again, which I guess I do. Let me just move this higher like this. So the dollar hit a high of 101.34 on Friday. That is going to be my support point longer term for the dollar. When Europe finally comes out of their grand funk, you're going to see the euro go up and the dollar is going to come down. It's going to be a great trade. We're not ready for it yet. If we look at the euro, you'll see the euro is down, coming down to my target. My target for the euro is around 107 to the dollar, but it's down around their 2022 lows right now. Okay, I think the euro is going to run back up this way, just not yet. If they do a negotiated settlement between Ukraine and Russia, and they end the fighting, then you're going to see the euro just really springboard higher. It's going to be really, and so will the rest of the markets. But from a currency perspective, you're going to see the euro go up. Now, the one that everybody's talking about is the yen. We haven't been short the yen in a long time. This is a trade I didn't take, but you can see just where the yen is, right? If I put it on a weekly chart, you can see how ugly the yen is. It has just been rolling over and over. Eventually, the yen is going to stop, find a support point, and then move higher. Now is not the time to chase that yen to the downside. I mean, to the upside. It's like catching a falling knife. This yen can go a lot lower. So we're just holding off right now. I want to see a move up, a rally, a sell to rally, a come down, ideally make a lower low, but we get a divergence in the indicators, and then boom, we jump on it on a trigger back up again. Right now, the 50 is well below the 200. Any rally is not going to get north of the 50 EMA. That would be a huge rally. I don't even see that. I see a weak rally, a failed attempt at a rally, a sell-off, more of a consolidation before a run higher, okay? We come down and look at gold. Well, gold doesn't like higher interest rates. I think what's going to happen with gold is going to come down to this shaded zone. You can see where it's testing the 50 EMA again. I do believe gold is just going to chop around for a longer period of time. Not until we get a little bit uglier is gold going to start another run and challenge this 2,000 level again. I mean, we're holding 1,900, but I could see us giving 1,900 back up in gold. Same thing with silver. Longer term, if you've got a very long-term outlook, being long gold or silver makes sense. Short term, meaning through this year, I just don't see it. You can see silver's come back down below the 50 and the 200. So just not very good, right? And of course, if we look at energy, we got a way to trade energy. Traders that are following the approach I like to use are making money in oil right now. And you can see it's probably going to come down and test that 50 EMA. It may come down a little bit lower. I don't see it going much lower than $90 a barrel right now. If they do a negotiated settlement, you'll see oil come down $6, $7, $8 a barrel in one day, and it'll come back down and test that lower 90, upper 80 per barrel range. Right now, it's just on a steady drumbeat lower. Every rally is being sold off, but we still have strong buyers coming in the low 90s. I see that near term. The only thing that can change that, of course, is any kind of thing coming out of Ukraine and Russia. I don't think the Iran deal is going to get done as soon as Sippy Cup Joe wants to get it done, the Biden administration. So that's just going to keep upward pressure on oil for now. Okay. Nat gas had an ugly day. You can see this big move lower here on nat gas. I think it's going to catch itself somewhere around here and get a long consolidation and then start moving back up again. And then it's probably going to hit another sticky point and pull back down again. So this is a profit-taking move right here. That move right there is a very bullish move in nat gas, very bullish. If we look at the volume, you can see how the volume, as we're moving higher, my 5/20 EMA in volume went up a lot. Now look, as nat gas is coming down, the volume is also coming down. So that just tells me this is a profit-taking move. You're going to see this thing start to hold up. And then we're going to go back higher again. Okay. So that's a little bit about where I'm sitting here. One quick thing I haven't talked that much about wheat, corn, some of the ags. The ags, corn is up very high levels up here. I like the idea of playing a downside move in corn. Again, a negotiated settlement with Russia and Ukraine. You're going to see corn come down, lock limit down in the futures market. Really big moves down. Okay. Remember, they don't have lock limit moves in the options market, but the spreads get pretty wacky. But I do like corn to the downside. Same thing with wheat and soybeans. All right. That's pretty much it at a high level. Members, I will see you this Sunday evening. Got a lot to talk about, a lot of things to look at, a lot of opportunities. If you're not a member, I highly encourage you to come in and check us out. We're having a lot of fun this year. And it's going to get very interesting over the next 90 days with the Feds. All right, everybody, have a great weekend. Folks, I'll catch you later. Ciao now.